Hello, everybody. This is Chapter 3, Managing Financial Health and Performance. In this chapter, we will review the basic financial statements and show how to use them as templates for financial planning. We begin by reviewing current accounting roles in financial statements. There are three basic financial statements: balance sheets, income statements, and statements of cash flow. In Section 1, we will explain the first two based on the hypothetical example of Generic Products Corporation, GPC. First, let's see the balance sheet. A firm's balance sheet shows its assets, what it owns, and its liabilities, what it owes at a point in time. This table presents GPC's balance sheet at two different points in time that bracket the year 2021. The balance sheet consists of two parts. One part is assets and another is liabilities and stockholders' equity. Stockholders' equity is the net worth of a corporation, where the net worth is the difference between assets and liabilities. In specific, let's first examine the balance sheet on December 31st, 2020, just before the start of 2021. For the assets, the first content is current assets, which are defined as cash and other items that will be converted into cash within 1 year. In GPC's case, the current assets consist of cash and marketable securities, $100 million, receivables, $50 million, and inventories, $150 million. Inventories consist of raw materials, goods in process of production, and finished goods. So the total current assets are 100 plus 50 plus 150, $300 million. Next come non-current assets, which consist of property, plant, and equipment, PP&E in short, and is $400 million, less accumulated depreciation, $100 million. The net PPE is $300 million. The sum of total current assets and net PP&E is the total assets. That is, the total assets equal total current assets, $300 million, plus the net PP&E, $300 million, and are $6 million. What's the depreciation? Depreciation represents how much of an asset's value has been used. There are several methods that accounts commonly use to depreciate capital assets and other revenue-generating assets. Using the straight line method is the most basic way to record depreciation. It reports an equal depreciation expense each year throughout the entire useful life of the asset until the entire asset is depreciated to its salvage value. For example, suppose that a company buys a machine at a cost of $50,000. The company decides on a salvage value of $10,000 and a useful life of 5 years. By the straight line method, the depreciation amount is $50,000 minus $10,000 altogether divided by 5, and is $8,000. Let's see the liabilities and the stockholders' equity of the GPC. Liabilities that must be paid off within a year are called current liabilities. For GPC, current liabilities consist of $60 million in accounts payable, which is the amount owed to its suppliers, and $90 million in short-term debt. The next one, long-term debt, consists of bonds with a face value of $150 million maturing in 2027. The interest rate on these bonds is fixed at 8% per year. The difference between a firm's current assets and its current liabilities is called net working capital. It does not explicitly appear as an item on the balance sheet. GPC's net working capital at the end of 2020 was $150 million, which is equal to the current assets of $300 million less current liabilities of $150 million. The final category on GPC's balance sheet is stockholders' equity. The paid-in capital, which is the amount that GPC raised in the past by issuing common stock, is $200 million. The retained earnings, which is the cumulative amount of past earnings that have been retained in the business, is $100 million. The total liabilities and the equity are the sum of the total current liabilities, long-term debt, and the stockholders' equity. Note that the total liabilities and the equity, $600 million, are equal to the total assets. The market price per common share, $200, is added at the last row of the balance sheet. That's all about the balance sheet. Next, let's see the income statement, which summarizes the profitability of the firm over a period of time. This table presents the GPC income statement for 2021. The sales revenue is $200 million. The cost of goods sold, $110 million, is the expense GPC incurred in producing the products it sold during the year and includes the materials and the labor used to manufacture them. Gross margin, $90 million, is the difference between revenues, $200 million, and the cost of goods sold, $110 million. General, selling, and administrative expenses, $30 million, represents the expenses incurred in managing the firm, such as the salaries of the managers, and in marketing and distributing the products produced during the year. The operating income is equal to the gross margin less the general, selling, and administrative expenses. That is 90 minus 30, $60 million. The operation income minus the interest expenses results $21 million, leads to the taxable income, $39 million. At a tax rate 40%, the income tax, $15.6 million, results from $39 million multiplied 40%. The net income is equal to the taxable income minus the tax. $10 million of the net income were paid as cash dividends. The left part is the change in retained earnings. Because of the 1 million shares outstanding, the earnings per share are $23.4. In summary, in this section, we have explained the construction of two financial statements, balance sheet and income statement. That's all about this section. Bye.